Welcome to the Cashflow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome back to the Cashflow Project Podcast. I'm your host, Steve Fierros of Tri-City Equity Group. Today, I'm excited because we've had my partner, Duc Ong, on the show. You know, for our longtime listeners, you of course would know Duc from the very get-go. He was co-host for the show for a long time, for many episodes. So I'm glad to have him back on. Today, we're going to talk a little bit about investment exit strategies, syndications, and whatnot. So looking forward to the show. Duc, welcome back.
Thanks for having me, Steve. Happy to share some insights on this topic.
So now more important than ever, people need to know kind of what to do with their cash, whether it be sitting on the sideline somewhere, or maybe they're coming out of some investments. The last few years have been great times to be investing in real estate and stocks, equities and whatnot. So for those of our listeners that know about Tri-City, they know obviously we do multifamily investments, commercial investments. Obviously there's a number of different asset types that we can invest in, but kind of before we dive into some of the exit strategies, can you give our listeners a quick overview of kind of real estate, let's say syndications, how those work, and maybe the current state of kind of where our company is at?
Sure. So real estate syndication is when a group of investors pool their capital together to invest in a larger asset, such as apartment buildings. The sponsor puts the deal together, raises the funds, and manages the property. Investors become limited partners with a passive role. And syndications allow regular everyday investors to be able to participate in higher quality institutional level commercial assets that they normally couldn't access on their own. Typically, deals usually last between 3 to 7 years. Now, for us at Tri-City Equity Group, we currently own and operate 7 assets ranging from 50 to 102 units in the Dallas and the Mid-Atlantic region, comprising of 449 units valued at over $55 million. We have sold 5 deals, 3 of which were syndications, and the other 2 were JVs. On our 3 syndications, our average annual return was 41%, with an equity multiple of 1.76 over an average hold time of 1.8 years. So let's break down those terms for a little bit for those that are not familiar. So average annual return is just a straight, simple return divided by the time, so the number of years that you held it. Equity multiple is how much your initial investment gets multiplied by upon exit. And our average internal rate of return was 33%. And what does that mean? Internal rate of return is a measure that takes the time value of money into account. So it matters when you receive those returns. So if you receive the returns earlier in the hold period, then your IRR would be higher. So if we take our 2 JVs into account, our average IRR is about 38% with an average equity multiple of 1.89 in 2.25 years. So that's basically our track record so far. And the most exciting thing is we are looking to launch property management company, Black Sand Property Management, to specialize in the Dallas region, which will allow us to vertically integrate and save on a lot of costs and be able to create even better NOI, which would lead to that overall exit that we're looking for.
Yeah, so super helpful, right? So the fact that Duc's able to break down some of those numbers and you start to understand some of the returns. And for those who may not be familiar, go back and rewind 60 seconds and kind of listen to some of those returns, some of that track record, and super, super important. So when you go on to listening to, let's say, the current state of economics, right? And you'll hear, well, hey, the CPI or the average inflation rate, let's say, is running 8%. Or, hey, you wonder why the cost of groceries and the cost of fuel and just your living expenses are getting so high. You need something to combat that type of inflation. So you're going to need something better than the 4% return, let's say that your local bank is offering for their high yield savings account, right? Or a CD or something along those lines. So I've had investors comment on our returns like that when Duc was you're talking about, and it's like, well, this can't be real, right? They can't be real. It's like, well, no, it's absolutely real. And then you'll start to understand why This is why the big money, hedge funds, this is why institutional money will start to park their capital into assets like this, because then you can get the return. That's all tax advantage, stable assets, great markets, right? And this is the kind of stuff that we're looking for. So super, super helpful for our listeners, right? To get some kind of a context in terms of what we're talking about in terms of returns. So let's talk exits, right? Because obviously we've had multiple exits within the past couple of years here. Those timelines of the market's been great for us and being able to return not only a capital, but obviously significant amounts of return. I've personally used that to invest in other asset classes in addition to more commercial assets along with our group and diving more into commercial multifamily. What are some typical other ways that syndication investments can end and investors can actually get their profits back to go and take on to either more projects or do whatever with, right?
So the most common way is a sale of the property at the end of the business plan. Investors not only receive the original capital back, but also return on that investments from the sale proceeds. So let's take a look at our last exit in El Paso as an example. If you had invested $100,000 initially, you would get $93,000 in profit plus the $100,000 capital back, in addition to the cash flow distributions that happen quarterly throughout that whole period. So the total return in that case was $103,000 on the capital plus the initial $100,000 to make $203,000. So essentially we multiplied $100,000 by an equity multiple of 2.03 to get to $203,000 approximately. Now,
Right.
we don't want to promise those numbers because in investing, everything has risk and nothing is guaranteed. And we typically project for about a 2x equity multiple, which is 100% total return in 5 years as a target in order to pass our underwriting criteria. So I don't want listeners to think that you can always get that 103% in 2 years. That's just an exceptional edge case. But we always strive to perform like that by having conservative underwriting standards.
Right. So knowing that you can get that this type of return for one is possible, right? And again, this is why you'll get some investors as we're networking and talking to other people. Well, this is too good to be true. And it's like, well, no, here's the track record, right? It's absolutely possible. It's not just possible. It's not a unicorn thing. Again, maybe the timeline is and how quickly we're able to get that return. That's not an always kind of thing. And obviously what we're talking about, none of this is investment advice, right, guys? So talk to your advisors and kind of do your own homework and research. It's all kind of edutainment. But we do want to be able to provide you guys options and opportunities, really just so you're understanding what's out there. So when somebody comes to you with an investment opportunity that says, okay, well, hey, I can make, your return could be 6-7% or something. You should know that there's other tax advantage opportunities out there that can take you way further. Again, you want your money kind of moving on the fastest train if you're focused on growth. And a big priority I know for us is always going to be preservation of capital, right? Like Duc, you've mentioned a couple of times there, hey, you know what, that initial, I'm talking about equity multiple, the initial it's always going to be the return of your initial investment, right? So that's the highest priority for us is, hey, number one, we don't want to lose any money. We don't want to lose our money, your investors' capital, any of that kind of stuff. So preservation of capital is always a priority, but to know that the investment return is there and substantially is huge, 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 huge. So something else too that Duc mentioned there is you can actually make money from the cash flow and then also whatever the capital event is, right? So if it's a sale, if it's a refinance, there's a couple of different ways that you can make money going into the syndication route. Now, what about Duc? What about something that's more tax deferred, right? So if it's a 1031 exchange or something like that, if an investor's got capital like that, how would that work? How would that fit into a model like this?
So 1031 exchange is another way to exit. So what that is it allows you to defer capital gain taxes by rolling the proceeds from one investment into another like-kind property. So it's a way to keep compounding the returns while deferring taxes. And the key here is that we're deferring it, not avoiding it altogether, because if you stop the 1031 train at some point, then you're going to have to pay the taxes. But the strategy is you just keep doing it forever. However, it's tricky because you have to get the property identified within 45 days, and you have 180 days to close on the replacement property. So if the timing doesn't work well, and you can't find any good deals, you don't want to force it because then you might buy a bad deal just to save on taxes, and then it's actually worse as far as the bottom line later on. Now, You don't necessarily have to do a 1031 to benefit from the tax benefits of multifamily, however, because in every deal that we do, we always do something called a cost segregation study, which allows you to break down the components between real property and personal property. And in 2023, you can 80% of the bonus depreciation, which is huge because that creates this large passive loss in the first year, which you can then use to offset passive gains and other capital gains potentially. But you definitely want to check with your CPA on that.
Yeah, definitely. This is part of the awesome tax advantages of investing into real estate in general, right? Now, normally, let's say cost segregation studies and whatnot, they can be typically cost prohibitive for something that can generate, let's say, the losses or doesn't make sense. So for most long-term investors that are just doing, I've got a single family house somewhere in the Midwest or something like that, it's probably not going to pencil for you to do it. But for something like this, where a commercial asset, it's a larger, obviously have a much bigger value, much larger value, you can generate a much larger paper loss, passive loss. And again, just like Duke's point, none of this is tax advice. Always consult with your CPA, whoever's handling your taxes, your tax professional. But it's a very, very powerful strategy to help to not only offset, again, those your losses or offset your gain rather. That gives you much more velocity, right? Because now you can also take that additional capital that you would have been potentially paying for taxes, and roll that into another deal, continue to buy more real estate, generate more income. So it's an awesome way. Well, now too, so next, of course, that's huge. Now we talked a little bit about refinancing. Can you explain how that could factor into, let's say, a value add deal where that can actually get some additional profits going to investors as well?
Yeah, so our strategy is value add. And in typical value add deals, you renovate the property in order to increase rents and the overall value, because in commercial real estate, the value is determined by the net operating income, NOI, divided by the market cap rate. So the higher you can push the NOI, the higher you can push the value. So when a sponsor creates equity in the deal, you can refinance to pull cash out and return some or all of the capital back to investors. And in our typical equity structure, investors keep ownership so that you continue to benefit from increased cash flow and depreciation over time. And it's a great way to extract the value out of the asset without selling it. We have done this twice on two of our assets. The first one was a complete return of capital, and all the investors continue to benefit from the cash flow on that. And the second one was about a 21% return of capital, and everyone's still benefiting from the preferred return and eventually the proceeds from the sale. Now, what I like about financing is that the proceeds are tax-free because it's a loan. So you're just taking more of a loan out. So it's one way to get income without having to pay taxes.
Yeah. Super powerful, right? And this is how the wealthy do it, right? They leverage, let's say, existing asset, put debt on it. And that way you're not actually, there's no tax burden on that, right? It's the same capital. We're just refinancing it, taking those proceeds out. And again, that's not a taxable event because it's all debt, right? So again, these are powerful strategies, you guys. So also too, like this whole structure like that, it's some of those, let's say of our listeners that may be from rental operators or flippers or wholesalers, more used to, let's say, investments on the residential side. You may be familiar with the BRRRR concept, right? So this is effectively a large scale BRRRR, right? We're doing a value add. So you create value, you force equity. Now, the nice thing is with commercial assets, you're able to do that additionally than something beyond just doing, let's say, a rehab or something like that. Decrease operational inefficiencies, increase other revenue in other areas to boost your NOI. But again, it's a super, super powerful strategy. It's like a BRRRR on a residential, like on steroids, right? So now, let's say once we do that, let's say if I'm an investor, I'm a passive investor in a syndication, and we do a refinance or something like that, or I get some capital back, like what kind of options do I have at that point? What else can I do with that capital? And I'm going to be hunting for some other kind of opportunity to put that capital, right? You don't want to eat, let's say, that future seed plant. What else can we do? What would you have as recommendation for that?
All right. I can share my personal story on how I used proceeds from the various deals that we exited. First is to be conservative, you want to consult with a CPA to figure out what your tax liabilities might be on that gain. Because in our past examples, if you have a significant gain, there's going to be a tax liability. Despite the fact that it's tax advantaged and you have passive losses to offset some of that, there's still going to be depreciation recapture and wherever that capital gains is. For us, it's always going to be long-term capital gains, which depends on your income. So every situation is different. Please consult with a qualified CPA on that. And then you want to reserve funds, right, for that tax liability. So you don't want to spend all of your profits. You want to be sure that you have enough to pay that tax. So second, once you've taken care of that piece, then in our current high rate environment, there are lots of options for risk-free rates, essentially high yield savings accounts. They use treasuries and various tools like that. Personally, I use Wealthfront. They have an automated bond portfolio as well with a little bit more projected yield. It's in the 5s. And yeah, the savings account itself is in the high 4s, I believe, as of this recording. Now, the key is that you want to maintain liquidity with those funds because you want to be able to take advantage of other deals that might become available after the one that you were in exited. Now, in my opinion, the best option, if you can find the right deal and the timing works, is just to place that capital into another syndication deal. Now, I mentioned this earlier because the multifamily syndication deals typically create large passive losses. You want to place that capital as early as you can because that rule I was talking about with the bonus depreciation, in 2023, it's currently 80%, but it's going to phase out by 20% every year. So 2024 will be 60% and so on until it's completely phased out. Now, who knows what laws will come at that point. But as far as the current IRS laws, it's better to get into multifamily deals before the end of 2023, if you can, so that you can reap the passive losses from that, because it's only going to get worse in the following years as far as that bonus depreciation rule. And then the nice thing is it's a bank. You can just bank the passive losses and then carry it forward to future years if it's not eligible. And it typically gets unlocked when the property sells. If you're just a typical W-2 worker with just a passive income and passive losses. However, if you're a real estate professional for tax purposes, you could also offset your active income, such as commissions, using the passive losses. And the caveat to that is that you want to be careful about the tax bracket that you end up being in, because it's possible to overdo it and be in a really low tax bracket one year, but then be in a higher tax bracket following year. So that's part of the tax planning that you want to talk to a CPA about to figure out how you want to play it over a long term. Because to me, one of my goals as far as taxes is to maintain the lowest tax bracket possible on average over the long run. Like, I don't want it to be too volatile because I don't want to have to pay large taxes in one year that I didn't expect. And in other years I'm saving, but then I'd rather have it just be smooth. So that's just one strategy to consider. Now, if you aren't able to find another syndication deal that you want to invest in, or nothing looks appealing to you, another possible option that's outside of the whole stocks and bonds world is various cash value life insurance policies, such as whole life, infinite banking type policies, or equity index universal life. These can be very lucrative if you structure well and have the discipline to have the long time horizon, because the liquidity is usually not great in the initial phase. But once you can get past that and you build up cash value, then you can take tax-free policy loans against your policy and use that to invest in syndications. And you actually get the benefit of interest credit in the account while you have that loan out. And then when syndication exits, you can always pay the loan back and then repeat. But essentially, that's one way to kind of act as your own bank. But how about you, Steve? Yeah. How did you use your proceeds?
Yeah, so we've done a couple of different things with it, and actually to touch back on your last point about the life insurance, we've done a couple of recordings with different people who are doing, let's say, infinite banking, right, or investing in some of these insurance policies. So make sure you check out the previous episodes. We can link them down in the show notes as well. But definitely dive back into some of the episodes that we've previously done to kind of explore a little bit more of that, right? So just to Duke's point, if you have a long enough time horizon, it's a great way to carry forward wealth if you're thinking generationally as well. It can serve you now and then also serve you later as well. I personally use, talking about sale proceeds, obviously we dive back into more syndications, more multifamily within our own investments, but I've also personally used it to buy short-term rentals as well. Short-term rentals, you can also do cost segregation as well. Some of the, as it's gained kind of more popularity and there's more people actually providing the service, you can do it for, a more affordable rate, let's say, and it pencils, let's say, for a short-term rental, just because the income is there. But we've done that to buy more, to boost more active income, again, to take that income, pour it back into more of the passive positions, into more syndications, more multifamily. And so everything to ramp up active income. And then we, take those seeds and go park them into passive positions, let's say, into syndication. So you kind of get the best of both worlds here. But that's definitely what we've been doing on our, let's say, proceeds coming from exits or refinance. And if you guys didn't catch that earlier too, when you do refinance out of any of these deals, that's an infinite return, right? You don't necessarily, if you're able to get all your capital back out, you still continue to collect cash flow, let's say on one of our Virginia deals, and it's infinite, right? There's no more initial capital back in the deal. So that's really powerful, you guys. That's true mailbox money. You're not doing anything for it. If you're a limited partner, let's say, you just get a deposit. It just comes into your, either you get a check or you have some kind of deposit account. And as a real estate investor, that's what we're striving for, right? Nobody wants to deal with the tenants and the toilets and all the turnover and stuff that happens. When people think about real estate investing, we can do it in a tax advantage way. It's true mailbox money. It's pretty awesome. And to know that you had all your initial money that you put into the deal back out of it. And it's just an infinite return, right? There's no calculation on that, right? So, but yeah, that's just the power of real estate investing in general. But yeah, no. So anything else to add, Duc? I mean, it's obviously, we know the benefits of that. And so we're just trying to share some of that education and share some of our experience with the listener. Hopefully that's been helpful for you guys. Anything else that you want to add, Duc? Or
No, I think we pretty much covered it. I think multifamily continues to be strong fundamentally as an investment option. I feel like with all the demographics and the trends and the lack of affordability, multifamily in the long run will outperform other assets, especially when newer families and households are not able to afford to buy a house and they're forced to rent. It's good to be multifamily owners and reap the benefit of that rental demand. And I don't see that trend changing anytime soon.
Yeah, no, I totally agree. And yeah, and again, it's a long-term play. But again, if you put everything on a long enough time horizon, let's say, and especially when you're dealing with commercial assets, that's typically the case, you win, right? So this gets to everybody to start thinking a little bit more longer term. But for the foreseeable future, I think we may have seen some of those articles, Renter Nation. I'm sure if you look around, prices compared to 5 years ago, the real estate in your market is very likely completely elevated, especially with today's rates and the whole kind of macro picture. I think it's going to continue to be a smart investment for the foreseeable future. So, but all right, well, Duc, well, thanks so much for coming on with us today, guys. Again, if you're interested in investing with us and to learn more about what we've got going on, go check out our site, tricityequity.com, to learn more. Schedule a call, and you can definitely take a look at some of our past projects on there as well. To connect with other local like-minded investors, if you're here locally in Honolulu, if you're coming on island, if you're going to visit, you're taking a vacation or something like that, and you want to connect with people while you're here, make sure you check out our Facebook group, Honolulu Multifamily and More. We host monthly real estate meetups. So if you want to get around like-minded investors, you want to kind of pick their brain, if commercial and multifamily is something you've been interested in to learning more about, come and meet people who are actively doing that. We host monthly meetups here locally. We'd love to come out and shake your hand and put a face to the name and meet you and help you in any way we can. Of course, if you guys are finding value in the podcast, we'd love to 5-star review. If you're thinking of ways that we can improve hey, if you didn't love it, that's totally fine too. Leave us a comment. We'd love to find out ways that we can make improvements on. And if there's topics or guests that you guys would like to see on the show, make sure that you're letting us know. We'd love to be able to do that for you guys. Of course, make sure that you're sharing the episode as well if you are finding value, and we'd love to connect with you in the future. All right, guys, that's going to be it for today. For Duc and I, we're going to be signing off, and we'll see you again next time. Aloha.